Good evening, ladies and gentlemen. This is Barry Norman. I'm on behalf of Investing.com, and welcome to our class, Unraveling the Mysteries of Cryptocurrency. Now, tonight's class is sponsored by Investing.com, and it is part of our new 5-part series on understanding cryptocurrencies. Now, tonight is the first of this 5-part series, because you can't just learn everything in one class. There's a lot to know about cryptocurrencies and digital coins. A year ago, we were only talking about Bitcoin. Today, most people are amazed to find out there's estimated to be between 800 to 1,000 different digital coins in the marketplace. Now, cryptocurrency is a digital currency recorded in a ledger of accounts and transactions between peers using a system of verification and encryption. Okay? Transactions are made by sharing a public password attached to a private and encrypted digital wallet. Each password relates back to a block of transactions on a digital ledger called a blockchain and expressed X amount of digital coins. Well, that sure didn't explain much, does it? I read that and I still don't know what a digital coin is or what a crypto coin is. So let's try again. Cryptocurrency is essentially a digital ledger of transactions secured by cryptographic codes. You know those codes that were became famous for in World War II that nobody could break. And it acts as a centralized or decentralized currency which can be exchanged between peers by sharing public passwords that relate back to digital wallets. Now, that didn't help me too much either. So let's see if we can get it a little bit more simplified that the masses who aren't all about internet and understanding technology can really understand. So Bitcoin is a digital currency created in 2009 that uses decentralized technology for secure payments and storing money that doesn't require banks or people's names. It was announced on an email circular as a way to liberate money in a similar way to how the internet made information free. A digital currency used to make payments of any value without fees. It runs on the blockchain as a decentralized ledger kept running by miners whose powerful computers crunch transactions are rewarded in Bitcoins. So here, let's try again. Cryptocurrencies use decentralized technology. Decentralized simply means it's not in a center. It's not a bank that has a corporate office. It's not a government that has a central bank. It is almost Forex is actually traded off of exchange. It's traded through a set of computers around the world. Well, cryptocurrency isn't much different. It is decentralized. There is no center origin. Okay? There's no one in actual control. So cryptocurrencies use decentralized technology to let users make secure payments and store money without the need to use their name or go through a bank. They run on a distributed public ledger called blockchain, which is a record of all transactions updated and held by currency holders. Cryptocurrency is a form of digital money that is designed to be secure and in most cases anonymous. It is a currency associated with the internet that uses cryptography, the process of converting legible information into an almost uncrackable code to track purchases and transfers. Cryptography was born out of the need for secure communication in the Second World War. It has evolved in the digital era with elements of mathematical theory and computer science to become a way to secure communications information and money online. Now, let's imagine that your bank, whether it's HSBC or Bank of America, whatever bank you're banking with, didn't have your name and your details, just gave you an account number. And every transaction you did is done by that account number. Well, that's kind of what banking is, except all of that data is stored inside the bank on only their computer and not shared with anybody. Now imagine all the banks around the world sharing all of this data with no names, but it's with account numbers, and decentralizing it so that every piece of data, every action, every bit of data would be stored on every single bank around the world's computer. Well, that means that nobody could ever change that data. Nobody could be fraudulent because all of those pieces of data are stored everywhere. So Bitcoin works on a public ledger called blockchain, which holds a decentralized record of all transactions that is updated and held by all the users on the network. To create Bitcoins, now, let me stop here for a quick second. I use the word Bitcoins because Bitcoins has become generic for digital currencies. As you know how we all use tissue or Kleenex instead of tissue. Even though tissue is what the product is, Kleenex has become universal for it. So we all say Kleenex. Or if you want glass cleaner, you say, give me the Windex. Well, when I refer in most cases to Bitcoins, I'm talking about the generic form of digital currencies, but saying cryptocurrency is a big word and hard to say over and over. So to create Bitcoins, users must generate blocks on a network. Each block is created cryptographically by harnessing users' computer power, and it is then added to the blockchain, letting users earn by keeping the blockchain running. So Bitcoin has a range of uses. Okay, forget the currency end of it. Forget trying to go shopping with a cryptocurrency. Okay, but it includes funding companies, investing cash, transferring money without fees. It is commonly associated, or was up until a few years ago, that was the biggest surge about it, about criminal activities such as drug dealing, cybercrime, and money laundering, since it can be nearly impossible to tie a Bitcoin wallet to one individual. That being said, today, to get money in and out of your account, you can have lots of Bitcoins, but if you can't spend the Bitcoins or can't convert them into anything, well, you have Bitcoins. Today, because of all the government requirements and anti-money laundering laws, somewhere when those Bitcoins are being transferred, whether it's into a credit card, back to your bank account, onto PayPal, however you are converting them out of this private network, you're going to have ID. So just like any other currency, from the US dollar to the money in your PayPal account, currencies primarily has value because we all agree it has value. Meanwhile, secondary factors include a limited supply, a demand for it, use value in the economy that accepts it in terms of exchange value because there is work behind it, etc. The same is true of cryptocurrency. It has little inherent use value, with the same being true for a bank credit in a bank account, but it is nonetheless has value in the modern economy. We agree it has value for whatever set of reasons. Thus, it can be traded for other things with value, such as real-world goods and services. With that in mind, although it is like a centrally backed state-issued fiat currency in many ways, there are notable differences. The main differences being it isn't backed by a central government. It isn't regulated by a central bank. And you can't use it to pay your taxes because it's not legal tender. So what are the terms we need to understand cryptocurrency? Well, there are 4 pieces of this puzzle that we have to master. And we're not even getting to the point of trading it, making profit in it, or buying and selling it. You have to understand blockchains. You have to understand what miners are. You You have to understand wallets, and you have to understand exchanges. So the blockchain is the technology that is used to move these small blocks of information that are used by a private and public key. Some call it a password, but it's not a password. It's a huge computerized algorithmic key. And when you open a wallet, and that's where you store you are given your private key. Anybody you give that private key to can send money to that key. But when they do a transaction, however they're doing it, to send it to you, it doesn't come directly to you. It's not like you're going into the bank, handing the teller money, and she's putting it on your account. It's not like you're handing somebody a credit card and they're charging it and the money's being, well, basically it is, because when you hand somebody a credit card, they run it, swipe it through their machine, and it actually goes through processors and exchanges and eventually is credited into the merchant's bank account. Well, this is what blockchain goes through. It's what carries the little pieces of data. But these little pieces of data are broken up to make them very safe and secure, and they get processed independently by what's called miners. So cryptocurrencies use specialized technology to let users make secure payments and store money without the need to use their name or go through a bank. They run on a distributed ledger system called blockchain, which is a record of all transactions updated and held by currency holders. Now, one of the biggest reasons of growth in Bitcoin and the surge in popularity is actually the demand for technology. The blockchain technology has been accepted by huge amounts of companies and financial institutions because it is a safe way to move data. That means there are ways that you can move signed contracts. There are ways you can move private data. There are ways that you can move lots of money. There's ways you can make micropayments. There are lots of ways that it can be applied outside of just cryptocurrency. So basically how it works, and I'm going to give you a more detailed example, but someone requests a transaction. That transaction is broadcast to a network of peer-to-peer computers. Okay. They're also known as nodes. They validate the data. Once they validate the data then comes through the network, is added to the blockchain as a permanent piece of data. So everybody in this network has this entire blockchain with that little transaction, piece of data, that transaction, but nobody can tie it back to you or anything else because it's all stored in little blocks of pieces, and not even whole pieces, just little blocks of pieces. But that transaction makes it to you and it is completed. And that's how you get your money, or you send money to pay bills. So cryptocurrency is a medium of exchange created to store electronically in a blockchain using encryption techniques to control the creation of monetary units and to verify the transfer of funds. Bitcoin is the best known example. So there is no human beings really attached in all this. There's no personal data really attached in all this. It's all done very inexpensively through the use of huge amounts of computing data. And that computing data is supplied to the blockchain by what's called miners. And these miners are the ones who approve the transactions. So a blockchain ledger of all Bitcoin transactions, with new transactions are made of blocks of transactions and are added to the sequential blockchain. This blockchain keeps getting longer and longer, and everybody out there has the same exact blockchain. All of that data is in the same place, and everybody sees it, everybody has it. So therefore, it can't be fraudulently changed. Blockchain technology is the heart of Bitcoin and is common to most cryptocurrencies. So the gist of block coins: in order to send and receive Bitcoins, a Bitcoin user must create a transaction and broadcast it to the entire network. For a transaction to be successful, it must be added to the blockchain. Now, miners, and this is where we're going to spend a little bit of time talking about miners. Miners are those in the network competing to collect the transaction data, verify the transactions against the existing blockchain, and to solve the cryptographic puzzle that allows them to add a block of recent transactions to the blockchain. And for all of this work that their computers do, they are paid or receive a reward of a tiny increment of a new coin. Because this is how new coins are created, through miners, through the work that the miners do. So all the miners are out there competing because they want that transaction to come through them. And it's a big electronic puzzle. And their computer takes huge amounts of CPU power to do all the computations to verify it, to solve the puzzle. The fact that so many have the same record and that so many are trying to confirm the same transaction helps to ensure each sequential block of the public ledger is accurate. Once a block is added to the chain, it is there forever and becomes public record. In other words, the blockchain is a public ledger of all transactions in the cryptocurrency network. And the Bitcoin blockchain is specifically a record of all Bitcoin transactions from day one to eternity. Every transaction. There is not a single movement, because remember, Bitcoin isn't a coin that goes in your pocket that you can hand it to somebody else and it goes away. It doesn't work that way. It's a Bitcoin is a piece of electronic data. So it doesn't exist except in this blockchain. So it's called cryptocurrency because many aspects of the above process are encrypted or use encryption. We won't get into the detail here, but generally, the transaction sent out uses encryption, the transaction recorded on the blockchain uses encryption, and the public ledger uses encryption. So even though so much is public, it is at the same time extremely private. In order for someone to make a transaction using Bitcoin, the transaction must be submitted to and what we refer to it as the community. That transaction data includes public passwords that relate back to the private ones. So the transaction is both anonymous and encrypted. Once the transaction data is public, community members can collect and verify the data and attempt to crack a very difficult computational puzzle that allows the transaction to be added back to the public ledger. As you may have picked up at this point, Bitcoin mining has very little to do with actual mining. Bitcoin mining is just one or more computers cracking a cryptographic puzzle to add a transaction to a blockchain. When transactions are added to the public ledger, new coins are created. Bitcoin mining is an integral part of how Bitcoin works. The Bitcoin network relies on miners to verify and update the public ledger of Bitcoin transactions, to verify that Bitcoin users aren't trying to cheat the system or to add newly discovered Bitcoins to the money pool. Now, miners are part of the community, but miners are businesses. Miners are in it to make money. So Bitcoin, which is the most popular currency, has lots and lots of miners. As you get to these newly created currencies, they have very few or no miners, because until you can convince a bunch of miners that it's worth tying up their computer time to verify a transaction, and that coin will eventually go up in value, because they don't want to get a tenth of a tenth of a tenth of a buried coin for that buried coin to keep falling in value, because they're losing money. They're not making money. So you have to interest these miners in processing your currency. So all these new currencies are really just held by the developer or in tokens, because there is there's virtually no miners out there. Currencies grow by attracting more miners, not more depositors, more miners, and building a community. So the entity that verifies the transaction, adds it to the ledger, is called miner. This is because when a transaction is added to the ledger, new coins are created and given to the entity as part of the fee, hence the name mining. Now, it takes work to confirm cryptocurrency transactions, secure a cryptocurrency network, and to mint new coins. Specifically, these things take what's called hash power of miners, who confirm new transactions, and in the process secure the system and create new coins. That work isn't for nothing. So it's all based on what's called a hash rate. I don't particularly understand this part. I mean, I'm not an IT person. So when they start talking about the technology end of it, I get a little bit lost. But a hash is the output of a hash function. And as it relates to Bitcoins, the hash rate is the speed at which a computer is completing an operation of a Bitcoin code. A higher hash rate is better when mining, as it increases your opportunity of finding the next block and receiving the reward. So these miners hook together huge amounts of computers that have huge amounts of CPU power. The work produces a secure ledger and the secure digital decentralized currency usable on the internet anywhere in the world. So the value are also represent the value system of having a sort of decentralized digital bank, accountants, and a system of digital currency. In order to add transactions to blockchain, all the miners collect the transactions recently broadcast by other Bitcoin users, verify the transactions are valid, and compile them into a transaction block. Of course, if any miner could simply create a transaction block and immediately add it to the permanent ledger, then anyone who wanted to just create a fake transaction block and add it to the ledger. Because of this, the Bitcoin algorithm is designed to make mining difficult. Instead of being able to add a transaction block to the blockchain at will, a miner has to solve a very difficult computational puzzle called a proof of work scheme. The proof of work scheme was designed to have solutions that are easy to verify but very difficult to find. In other words, what Bitcoin miners are actually doing is competing with each other to see who can solve a difficult cryptographic puzzle first. When one miner finds the solution to the problem, they broadcast their solution to all the miners. The other miners then verify that the solution is correct. If it is, the network permanently adds the successfully mined block to the publicly accepted block coin. And that miner who had solved the initial puzzle is paid a small fee. The miner who won the mining race and was the first to successfully solve the puzzle is then rewarded for his efforts with 25 newly discovered Bitcoins. The possibility of rewards acts as an incentive for miners to keep investing computational time and efforts into mining Bitcoin. The first creation of Bitcoins also acts as a way to add to the overall Bitcoin money supply. And this is how the creation of these blocks is how the supply of Bitcoin is carefully monitored. Because you can't just continue issuing Bitcoins endlessly, because then they'd have no value. If Bitcoin was trading at $5,000 a Bitcoin, and we have, I think, 18,000 Bitcoins in the world, and somebody says, I'm going to create another 8 million Bitcoins. Well, what do you think is going to happen to the value of Bitcoin? It's going to tank. So it's a very controlled release and supply. So you have to do a lot of work to get paid. And the final amount of Bitcoins is limited, I think, to 21 million Bitcoins, which isn't going to take that many years. But we have to remember this blockchain technology is used by almost all of the other digital coins out there. And one of the reasons blockchain split into blockchain cash, or a lot of the other currencies out there, use the exact same blockchain. Or you have coins like Ethereum who then modify it because they all fork off of the original Bitcoin. most of them all have the same, let's say, DNA. So cryptocurrency has had its fair share of interaction with social media, many of them rather unique. The value of Bitcoin lies as much in the idea behind its technology that it works. Social media network plays a vital role in the development and operation of cryptocurrencies, as well as the way their users communicate. Now, if you stop to think that this is a community. Now, right now, there's supposed to be about 5.8 million users. But these users are part of a community. They each trade on different exchanges. And when this community believes in something, they can push the value. So when a new coin comes out there, they don't have yet a community. So what they have today in the ICOs, they have the token people, but they haven't formed a community. This community interacts through social media and can build the buzz of a currency and build the demand for the currency. And once they have a built-in community trading in this currency, it starts to establish its own price. So the ever-widening availability of Bitcoin news has created a tremendous amount of interest in the value of the currency. But it also spreads uncertainty. The trading market in the cryptocurrency can fluctuate up and down depending on the character of the news being spread on social media. Hence, we saw what happened last week when China outlawed cryptocurrency exchanges. Okay. Bitcoin and the other cryptocurrencies fell about 30%. Now, they recovered after that, but as this news media flashes out there, it does have an effect. A widely shared story that claims an exchange has been hacked, for instance, can seriously depress the price of Bitcoin in a fiat currency. This explains why social media communication plays a vital role in pricing and valuing currencies like Bitcoin. The speedy sharing of information has even allowed traders in some situations to exit the market before losing too much of their investment. However, certain tools can be the purchase-like and skewed. Without the network's effect, the technology is nothing. It's just a theoretical amusement. Fundamentally, Bitcoins derive their value just as anything else does because people want them. Like any other currency, Bitcoin follows the basic rules of supply and demand. And again, remember, I'm using the term generically. Currencies have always been useful tools to make trade easier, enabling holders to convert goods into widely tradable commodities through sale. Then use the proceeds of that sale to purchase nearly anything they wish. Bitcoin derives its unique value from the fact that despite its lack of official backing or wide acceptance, it has generated an ecosystem in which many people are willing to trade or accept it. And this acceptance is growing exponentially. In fact, some perceive Bitcoin to be more valuable and more useful than other currencies in that it is a better option for certain purposes, such as seamless digital transfers and use across borders. Information sharing is vital important of developing and running a cryptocurrency like Bitcoin. Social media platforms have been a core part of the Bitcoin world since the currency's inception, and if not before. In the future, this trend may well reverse. But once you have a payment network, you need buyers and sellers. But the question then comes how to buy, sell, and store these coins. This is done by what's called wallets and exchanges. Because sooner or later, this technology, these miners, and this blockchain has to connect out here to the real world. So Bitcoin and other, now altcoins is the new word that's been developed for all the other currencies, or the alternative coins outside of Bitcoin, are digital cash, a way of buying and selling things over the internet. The first step is establishing a digital wallet, either via a broad-based web wallet or by downloading a desktop or smartphone wallet from Bitcoin.info, Mycelium, Basecoin, Electrum. There's a million wallet providers. Your Bitcoin address, as well as your public and private keys, are generated automatically when you set up a wallet. Now, because wallets are an integral portion of this, we actually have a whole separate class on the different kinds of wallets and how to use them and how to set them up. Your Bitcoin address is typically an identifier of 26 to 34 alphanumeric characters, beginning with the number 1 or 3 that represents a possible destination for your Bitcoin payments. For example, and I'm not going to read that off, but that's what a Bitcoin address looks like, and represents a string of characters or as a QR code. Now, your wallet is basically your bank account. Because Bitcoin is digital cash, your wallet does not contain actual cash. Thus, the term wallet is a bit of a misnomer. Your wallet has your address, your public and private keys, and a record of the amount of Bitcoin you control on the blockchain ledger, but not any actual cash. There really isn't any actual cash. Your wallet should be kept safe as any traditional wallet to protect your private keys. Anyone with access to them has access to controlling or spending or transferring elsewhere. Now, we have a class set up for understanding and finding the right wallet to use. It's like selecting the bank you want to deal with and the account type that works best for you. So on October the 8th, we have a class called 7 Ways to Safely Store Your Digital Currency. We'll talk about hot and cold storage. We'll talk about downloadable wallets. We'll talk about app wallets, and also the different features that wallets have. Because you should know what type of wallet you want when you select one. It is your first key in this whole thing. Because since you're not a bank, you're not going to use the blockchain except to make deposits and withdrawals, and you're not going to use the miners except they're going to process your credit card. So you have to have the credit card or the place to store your money, and that's vitally important. So on the 8th, we have a class called Safely Store Your Digital Coins. Now you need to get Bitcoins to deposit them in your wallet. You set up a wallet, there's the Bitcoin, there's the blockchain out there functioning, there's a miner out there functioning. Okay, everybody's out there functioning, but you're not a player in it yet. So you got to get the coins, and this is done through what's called an exchange. And unfortunately, most of the bad publicity that you've seen are related to exchanges, like Mt. Gov that went broke or absconded with so much money, was an exchange. A cryptocurrency exchange are online platforms where you can exchange one cryptocurrency for another cryptocurrency or for a fiat currency. In other words, depending on the exchange, it's either like a stock exchange or a currency exchange at the airport or the bank. So a traditional cryptocurrency exchange, these are the exchanges that are like the traditional stock exchange where buyers and sellers trade based on the current market price of cryptocurrencies, with the exchange playing the middleman. So there's some exchanges where it'll say Berry coin available for sale, and it'll have my name, and it'll say I've got 20 Bitcoins for sale. You can buy one or part of one. This is the rate that I'm asking for. You want to buy one or part of mine because I'm offering a better exchange, or I'm in somewhere whatever reason, the exchange hooks you and me up. And it's just like when you sell shares when somebody buys shares. The exchange is just the middleman putting it all together. These type of trading platforms generally take a fee for all transactions. So they're like a stockbroker. He's putting it all together and charging you a fee or a commission. Some of these exchange types allow users to convert fiat currency like the dollar and the euro, into cryptocurrency like Bitcoin at market price. Coinbase is a good example of that. So is Bitcoin Wallet, one of the most popular. Kraken, ShiftShape, they all offer different kinds of services for fees or without fees. To enter the crypto world, you need to learn all about these exchanges. And there's many types of exchange. There's peer-to-peer exchanges. There's exchanges where the exchange actually owns so many coins and they're selling you out of their block of coins. And Then there's the other ones we just talked about. There's many different types of exchanges. There's many types of fees. There's many types of services. But the one thing I'll tell you now is you may want to exchange your money there, but you want to make damn sure you move it to a wallet that's independent, because wallets are safe, where an exchange is holding all of your coins and it's exchanging them. They're not necessarily individual accounts. Okay? So exchanges are where problems can take place. So remember, when exchanges are legitimate, when you want to buy and sell, that's where you have to go. But don't leave your Bitcoins there for storage. So we have a class dedicated to understanding exchanges. So it's 5 need-to-know facts about crypto exchanges, and that's on October 13th. So once you've decided that you want to enter the crypto revolution, you need to decide whether you want to be an investor, a trader, or a speculator, or if you just want a new payment method. We will discuss all of these opportunities in our class on October the 6th, how to profit from the cryptocurrency revolution. But you can't profit until you understand the basics. So that's why we started out with the basics. So let's figure out, let's talk about it in everyday world, how it'll work. One of the best ways to learn about cryptocurrency is to see a real world example. Let's say Joe wants to buy a pizza from Jane, okay, with a hypothetical cryptocurrency called Berrycoin. See, I'm minting my own coins. So in order for Joe to transfer one Berrycoin, he sends out a transaction to every member of the Berrycoin network. In simple terms, this is a message to everyone with Berrycoin accounts stating that he is transferring one Berrycoin to Jane. To keep their identity safe, Joe uses a unique encrypted code that acts as IDs for his Berrycoin account and Jane's Berrycoin account. These accounts are often called addresses. Usually Joe and Jane will be using software to enable these transactions to manage their account, called a cryptocurrency wallet. Everyone in the cryptocurrency, the Berrycoin network, will receive a transaction that Joe sends out. Then all the Berrycoin miners, special members of the network who invest computational efforts into verifying Berrycoin transactions, compete to add that transaction to the ledger. So they're making sure Joe has the money and they're getting it over to Jane. So in order to add that transaction, they have to solve a complex mathematical problem with the help of computers. And this prevents Joe or Jane from being the one to write and record the transaction. The first one to solve the problem sends out a message to everyone who knows that coin type and declares that the transaction has been added. Everyone in the community then adds it to their ledger. To be safe, Joe and Jane wait until the transaction is complete before exchanging the real-world product services. This helps avoid some potential scammy things like double spending. The process usually takes about 10 minutes. Once the transfer is recorded in the ledger, the transaction is permanent. There is no way to recover lost funds or funds transferred in error. Jane gives Joe the pizza, and he now has what he's paid for, and the process is complete. So in most cases, you'll have a hard time finding anything other than Bitcoins, Litecoins, and Ethereums for actual money. Most wallets and most exchanges only deal with the largest exchange because they don't have liquidity or they don't have enough miners. Now, most coins will have an official exchange. So if you want Dash Coin or one that, go look them up, go to their website, and they'll tell you where you can buy one of their coins. But the problem is, in a lot of cases, you won't be able to find a wallet that'll store them because the wallets have to store the data for that particular currency. Because you can't get it in that wallet unless there's a miner who's going to get it to that wallet. You can trade most coins online at cryptocurrency exchanges, and you can use some coins to buy certain things online. But converting an altcoin to fiat currency generally means converting it to a major coin first. In other words, just because a coin has value in US dollars doesn't mean that anyone is going to give you US dollars or pay that rate for your coins. This is more like selling stock, or often penny stocks, or trading one baseball card for another. So keeping that in mind and the volatility of markets and coins in mind when investing. Okay, now, everybody wants to know about ICOs. Okay. Now, briefly, an ICO is a replacement for an IPO. It's a new business out there. It's becoming very scammy, unfortunately. And there's very little control over it. And most governments, a lot of governments are now outlawing them specifically. Before you can start talking about investing into cryptocurrency and possibly making some profit along the way, you need to discuss ICOs, not to be confused with IPOs. I'm going to recommend to everybody, and just like a lot of major people are saying, don't get involved in an ICO. Let's get to the point. What in the world is an ICO? An initial coin offering as a transaction type designed to help spur up and launch new cryptocurrencies and give them some traction. Essentially, it is a fundraising tool designed to boost the newly born coin into the online world. But you're not buying stock in that company that's issuing it. You have nothing. You're getting a token in the hopes that that cryptocurrency goes up in value and that when it does, there's even a liquidity or an exchange. Okay. Now, in the fiat currency world, most financial institutions see these ICO transactions as unregulated investments of cryptocurrency where users can make Bitcoin or other digital currencies. The key word here is unregulated because most of them today are traded using Ethereum. You have to go buy Ethereum, then convert the Ethereum, because Ethereum is not really involved in it. You have to then convert the Ethereum into that new coin. And now you're holding a new coin that has virtually no value. Okay, because remember, they aren't linked to ownership rights and thus can be traded or exchanged at will. In the fiat world, this is a huge no-no. So there are new laws coming out about ICOs, and in our next class on taking advantage of the revolution or profiting in this revolution, we'll talk about ICOs in more detail, as well as looking at some of the ICOs scheduled to come up on the market. We have a class scheduled to cover regulation, safety, government involvement in the digital cryptocurrency world. It's the 5th of this class. So the final word on cryptocurrencies. Bitcoin and many other cryptocurrencies open the doors to new types of digital money, which we think has the potential to someday become a leading currency in the world. At the moment, even the oldest of cryptocurrencies are still maturing, and only time will tell where this genius invention is heading. From what we can tell, there's plenty of room for advancement. At the same time, Bitcoin has already revolutionized the digital world. So if you're ready or want to buy your first Bitcoin, a great way to buy them is go to www.buynow-cryptocurrency. Now you have to have a wallet first because they'll accept your credit cards, and you don't actually even use an exchange. They deposit the Bitcoins directly into your wallet. So you just go to them at www.buynow-cryptocurrency, fill out how much Bitcoin you want. The purchase price will pop up. You put in your Bitcoin address, and then you click the purchase, fill in your debit cards or your credit cards, and you can have a Bitcoin in your wallet in no time flat. So go to www.buynow-cryptocurrency.com to buy safely and quickly and start out joining this revolution. Start with a Bitcoin wallet. Go to bitcoinwallet.com, and they're one of the safest wallets out there. Or Coinbase, and open a wallet, buy a Bitcoin, and just start playing with it. You don't have to buy a whole Bitcoin. You can buy a quarter, a tenth, you can buy a couple percent. Bitcoins aren't sold in whole increments. So, but remember, exchanges have fees, and always check them out first. So don't forget to join us for our other 4 classes, and we'll keep learning more and more detail about these. So have a very good night now. This class has been recorded. You can use the link you used for tonight's class to attend this class or watch this class in about 24 hours. Thank you very much, and have a great trading week. And thank you for supporting investing.com. By the way, real fast, I'm going to click up on investing.com. They have a whole cryptocurrency section out there. Okay. So if you go to investing.com, look for the top link of cryptocurrencies. They'll show you any price of any crypto coin against another, all the exchanges, different price and exchanges. They'll show you the most recent charts, the most recent trading prices. They can show you all the performance year to date. and all the up-to-minute news and analysis on all the cryptocurrencies. So that's right available on the investing.com website. Just look for the top navigation under cryptocurrency, under crypto, and you'll be able to get lots of information and see all the numbers, facts, and figures. So once again, thank you very much for joining us tonight. We appreciate it, and we'll see you in the next class. Bye now.